From birth to death, the Internal Revenue Service is your partner. We're going to talk about taxes next, right here on Due Process.
Major funding for Due Process is provided by Meade Lexus of Southfield and Meade Lexus of Lakeside, offering a large selection of new and pre-owned certified premium vehicles.
Someday, your life will flash before your eyes. Make it worth watching. Introducing the 2013 Lexus LS, an entirely new pursuit.
And by WWJ News Radio 950, keeping you up to date with the latest news, traffic, weather, sports, and business information 24 hours a day, 7 days a week. Live, local, and committed to Michigan's future. News Radio 950, WWJ.
Thank you. I'm Henry Baskin, your host for this edition of Due Process. We're going to talk about your income taxes and other taxes that you may face as you go through the next 20 years of your life or 30 years. Internal revenue is there from the day you're born until the day you die, so I thought we'd invite two experts down to talk about it. Angelique Neal, you're a practicing lawyer, and you were with the Internal Revenue Service, right?
That's correct.
Thank you for being here and helping us answer some of the questions. Wayne Titus?
Yes.
Similar, you're a certified public accountant.
That's correct.
Okay, so both of you, know it all, and all the questions that people have, I try to anticipate and ask you. For example, if you watch television, you're going to see ads that say, if you're in debt to the IRS, we can get you out, tax masters or whatever it is. How effective are these people?
Well, in terms of representation, a lot of those firms don't do everything that they promise they're going to do.
Are they certified public accountants? Are they lawyers? What are they?
No, most of them are just tax representatives. They can be anywhere from certified CPAs or just an accountant by trade. Some are enrolled agents.
Well, what do? Do they go down to the IRS and say, hey, I represent so-and-so?
They can certainly do that if the taxpayer signs a 2848, which is a power of attorney.
Power of attorney. But what do they do? How can you make deals with the government? I mean, you owe $600,000. I read the other day when one of the some actor Baldwin family owes money to the government, big money, and those of us who are behind a quarter or a year are immediately brought down to the federal building. What do these people pretend to do?
Well, when you say strike a deal, that's presumably going through the offer and compromise program. And that's where you're saying, okay, I know I owe $500,000.
Okay.
But I can't pay $500,000. You're not going to be able to collect it within the statute of limitations, which is 10 years. So take my $50,000. And depending on your financial situation, your equity and your assets and your future income value, that could happen.
Is the government likely to make a deal more often than not?
Not more often than not. In the offer and compromise realm, only about 20 to 30% are actually accepted.
Let me ask you, when an offer and compromise, that terminology is used, what does it mean? You make an offer to the Internal Revenue agent and they compromise the amount?
Right. If you have a liability to the Internal Revenue Service and you can prove, in essence, that you can't complete fulfillment of that obligation, you're offering, in essence, to provide a lesser amount.
What happens to the interest and the penalties that keep running on some of these accounts?
Well, if the offer and compromise is accepted, you pay for, in the example I gave you, $50,000, and
right.
You're done. Penalties and interest don't continue to accrue. However, once it's accepted, you have to stay in compliance for 5 years, which is timely filing your returns, timely paying your taxes, because if you don't, they will reinstate the full balance.
Okay, so you have to be sharp for 5 years and adhere to the law.
That's correct.
Okay. Does Internal Revenue ever get to the point where they'll say, well, we're going to put a lien on your house?
Oh, absolutely.
They'll do that.
They will send liens. They will lien the property, if it's your home or your business, your bank accounts.
Can they take your car and things like that?
think they would have difficulty taking a vehicle, but I'm sure they could if they needed to.
Okay, I mean, it's about how do you avoid this? If you can think about it and say, well, you know, I haven't taken money out of my paycheck. I told my employer to hold up, and they didn't do withholding. Or when you're self-employed, you can get in real trouble, can't you?
Yes, you can.
So what happens? What does the government say and do? When do they call you in? After a year, 2 years, 3 years?
When you say call you in terms of collection or?
Well, the problem is I know people who haven't paid taxes for 6 years. I know some who haven't filed a tax return. What happens then?
Well, if you don't file a tax return, the IRS does get income records from third-party payers. So your employer or you know, whoever you're contracting with, if they issue you a 1099, they're going to get information regarding that. And generally how it happens, about a year or so after the return due date is when you would be contacted about, hey, where's your return?
Okay.
I think you probably have a liability.
There seem to be a lot of people who don't file returns and no one ever notices. I mean, no one at Internal Revenue. Is there an automatic process for Internal Revenue to say, hey, so-and-so didn't file a return? How do they know you didn't?
Well, they look for a return. If you have income you know, that's been assigned to you by a third-party payer, they check
You mean
those.
by your boss, for example?
Right. But if you're working on your own and taking money under the table, there's less opportunity for them to recognize the fact that you earned income. And this is a problem if you're not reporting the income, because every taxpayer is obligated to make a proper report to the government.
Well, what do you do with people who get a check and cash it? Now, these are self-employed people and don't report the income. Now, is there a difference as far as not reporting your income or not filing your tax returns? Or are they treated the same?
They're somewhat treated the same, you know, as Wayne. Right, sorry. As Wayne said, you know, there's a matching program that goes on. So if the IRS doesn't know about the income, you're less likely to be picked up for audit. So it's only if they get wind, I guess, that you have taxable income.
Well, the reason I mention it, there's a lot of cash going around in some communities, and it's like I'm working and I get a check and I cash it and I don't report it. How would the IRS know about that?
Well, potentially through your bank account and making deposits in your bank account.
And if you don't make the deposits, they don't know about it.
Right, and this is tax evasion.
Okay, so tax evasion is different from not filing a return, right?
No, it's
Same?
not different. There's just different avenues of tax evasion. You can not file a return. You can unreport your income or underreport your income. You can overstate your expenses.
Okay, there's another issue we run into on a regular basis that has to do with the wives of husbands like Mrs. Madoff. She said, I knew nothing about it. Now, is she liable to the government because she signed a joint return?
She may be.
Right. When you sign a return as married filing jointly, you're basically accepting whatever's on that return as joint and several liability. So when there's adjustments made to that return to increase maybe income that he's absconded with, she could be on the hook for that, but she does have an opportunity to claim innocent spouse relief.
So there is something that says, I didn't know about it, so I'm innocent? I mean, does that apply?
Yes. Or even if you did know about it, but you know, potentially you were coerced into signing the tax return, there may be an opportunity, in essence, to file under that innocent spouse claim as well. So there's different circumstances where that innocent spouse claim might be successful.
Okay, everyone is sort of anticipating that in the year 2014 or 2013 there'll be some changes. There are some changes that are already past Congress that are set up, and there's going to be a change in how people how they pay tax or tax rates and things such as that.
That's correct.
You mentioned one at the before we started taping. That was the Obamacare?
Yeah, the Affordable Care Act and the tax provisions in the Affordable Care Act begin January 1st, 2013. The full act doesn't go into place until 2019. But initially, in 2013, there's the 3.8% surtax. It's called the Medicare surtax on investment income for couples over $250,000.
Okay, so if you have investments and you earn income, say stocks and bonds, and if you earn over 150,000,
250,000 for
250,
married, yes.
Okay,
and it's not just the capital gains and dividends, but
right.
also rental income and some other things.
Okay, and you have to. It's not your ordinary job; it's just some other outside job or income that you receive.
Yes, it's whatever falls under that definition of investment income.
Okay, then you have to pay over 3%.
3.8%.
Almost 4%.
On amounts above $250,000.
And that money goes where?
Well, it goes into, it basically is collected and is utilized to offset the costs in the Affordable Care Act.
Okay, when you say Affordable Care, you mean Medicare?
The Medicare program and any other component of the Affordable Care Act.
Are you prepared for that?
Prepared. I don't have that high of investment income.
No, not you, but your clients. Are they aware of these laws? I mean, or is it sort of like they'll find out sometime in 2013 or 14 that they owe 3.8%?
I think a lot of my clients probably aren't aware of all the provisions of the Affordable Care Act because there's so many. I mean, who could know them all?
Well, I look at both of you and say, how do you ever keep track of the ever-changing law of income and those kinds of things that affect people on a daily basis? I mean, it seems that Congress is always changing the law about deductions, exemptions, and things like that. For example, can a family deduct the expense of an education for a child?
There is some Hope Learning credits and tuition credits. I think some might be set to expire, but there are certain provisions that would allow you to deduct some of that.
Anything else going to expire automatically this year?
There's a number of things. I mean, there's mostly what I see is changes in rates, changes in amounts of credits, decreasing the additional child credit or reduces from 1,000 down to 500.
So the child care credit?
Right.
So if a working mother has to hire someone to enable her to earn income, she can deduct part of that?
No, I'm referring to the child. It's just a child tax credit.
Oh.
But you're referring to the dependent care.
Right.
Yeah, that's dependent care.
Yes. There's a deduction for dependent care.
Okay, what is the amount?
It was $2,500, I believe.
That's about it?
It might have gone up to $5,250.
Okay, so you can't take off the full amount you pay.
That's usually correct.
Okay. We're going to take a break. When we come back on due process, we want to talk more about the problems that you face and the problems that you face with some of your clients. We'll take a break. We'll be right back. Stay with us.
Legal referrals and more information on this and other related topics are available on our website at www.dueprocess.tv. There you'll find information on today's program, helpful hints to legal issues, support materials, and lawyer referrals. You can also stream previous episodes of Due Process.
Hey, we're back on Due Process with our guest talking about taxes. They never go away. They're always a part of our life. Tell me about some of the cases you've had that you've had moderate to a great success in getting reductions on offers and compromises.
Okay. Well, specifically, we do offers and compromise. The difference between my firm and like the ones you mentioned earlier is we don't submit them for everybody, because the key there is whether or not you can qualify for it. On cases that we've submitted, I mean, we've gotten liabilities down from $1.4 million down to I think it was $52,500.
You're kidding.
No. But again, as I mentioned earlier, it's all based on the taxpayer's financial situation.
Well, if someone owes $1.5 million to the government, they have to not be in great shape anyways. I mean, if they owe all that money, do they just come to your office and say, hey, listen, I owe almost $1.5 million in taxes. Can you help me?
Yeah, a lot of times that's what happens, or we get them because they've buried their head in the sand, hoping that it would just go away.
Right.
And now the IRS is filing tax liens, they're levying bank accounts, so we get them further in the stage of collection as well.
So they can actually take money out of bank accounts, right?
The IRS?
Yeah.
Yes, they can.
Okay, so what do? you ask these people what they don't have, if what they owe to credit card companies is, say they owe $50,000. Is that part of the offer in compromise, where you go down and you say this person's broke?
Yeah, we may say they're broke, but it's a calculation.
What is the trick? Let me hear the trick about getting a reduction from $1,500,000 in taxes to $52,000.
Well, unfortunately, there's no real trick, but you have to do the financial analysis. The trick per se is that now you have somebody who may have been doing well in his business, and now the business has closed because of the economy.
True of a lot of
whatever.
people. I guess I'm of the opinion that the Internal Revenue Service doesn't have a heart, that their job is to collect money. So I'm hearing you say that, hey, if someone is in trouble financially, you can make a deal with the government.
We can if the numbers actually show that we have the opportunity to make that deal.
So the criteria are listed, or just something that you develop as you talk to them?
Right. We look at the net equity and assets. So I
Right.
will ask them, what kind of assets they have. Retirement accounts are going to count, real estate, a lot of which is underwater nowadays.
Well, then you go down to IRS and talk to some analyst or someone?
Yeah, well, generally with the offer and compromise process, there's two components, just to back up a little bit. The future income value, that's really what's key if you don't have a lot of assets. But basically, you would submit an offer package either to the centralized offer unit in New York or go through the collection due process case.
How long does that take?
Offers can take anywhere from 3 months to 2 years.
Oh, really?
Yeah.
So it goes through many people to determine whether or not it's a valid request.
Exactly.
To compromise the claim.
And depending on how much you owe, there's different levels of involvement or oversight that comes into play as well on the IRS side.
When you take a power of attorney, you go down to IRS and talk to these people?
Yes, absolutely.
Okay.
Typically, we aren't going down to the office, but we're talking with them over the telephone. If there's an audit situation, we need to be present. We may have the Internal Revenue agent come to our office.
Okay, when they do the audit, what are they doing? They're looking at the books and records?
Yeah, they're looking at the books and records to make sure that the deductions that you took were valid deductions.
Okay.
That the income that you recorded was, accurate. And they're looking for completeness and accuracy as it relates to your return filing.
Where do people get, directed to both of you, where do people get them into the most trouble? When they take travel or entertainment or expenses that are not related to their business? Is that when they get in trouble?
I think most small businesses get into the most trouble when they aren't planning for basically their taxes on their employment income, so self-employment tax.
Okay.
The other thing would be if they're not paying their payroll taxes on time, if they're a corporation. And okay. I think that's where most people get in trouble. As it relates to deductions and things like that, most of my clients are trying to file complete and accurate returns, and as a CPA, I have a responsibility to do some due diligence to make sure that they're not taking deductions that are inappropriate.
Well, for example, I know people who private planes or travel and say, well, we're going to Scottsdale, Arizona, and while we're there, we're going to talk about a possible business. Then they come back and say, I want to write that off. Is that legitimate?
I'll defer to Wayne on that one.
I would say it would depend on the situation. If there's a business purpose for traveling, they can deduct the expenses as it relates to that business purpose. If they're traveling with a spouse and the spouse is not involved in the business, they cannot deduct the travel expense for that spouse.
Okay. Well, when you were with the IRS, what was your job at that time?
I did mostly tax litigation. So, for example, when the IRS does an audit, they issue a notice of deficiency. At that point, it's just a proposed determination. And
Right.
the taxpayer has 90 days to file a case in the tax court against the IRS challenging that determination.
And you represented the IRS, right?
Yes.
And what were these people trying to do when you went to court?
Well, with respect to the cases, it could be to challenge the unreported income amount that they came up with, challenge a fraud penalty that may have applied, argue for more deductions than that were allowed.
So that's where you back up the litigators who come in, like she's the prosecutor and you're the defense counsel.
Yeah, I'm not an attorney, so I'm not defense counsel, but
but
I am a taxpayer representative and can be a taxpayer representative.
Right.
So we would support the taxpayers.
And
argument.
then you have to justify some of the deductions that have been taken and made, right?
Mm-hmm.
Okay, what is the current situation going into the end of 2012 on inheritance or gifts and things such as that? Can you give a gift to a person in a certain amount without them paying a tax on the income and without you having to pay a gift tax?
At right now,
Right.
yes, there's certain exemption
Up to
amounts.
the end of 2012.
Right, and then it gets a little fuzzy going into 2000.
Tell me about that, what it is currently.
The exemption right now is for estate tax, $5 million. In terms of how much gift you can give to somebody tax-free, I believe isn't it 13?
13,000?
13,000. Yeah, you can split the gift between a husband and wife. So if you're giving one child a gift, you can give 13,000 from one spouse.
And it's not taxable to the receiver?
Nope.
Not taxable to the people who give it?
Correct.
What is the $5 million amount? How does that work? Is that when someone dies?
Yeah, for example, if someone dies and their estate is in excess of $5 million, they're taxed on the amount that's over the $5 million.
And that's a pretty serious tax, isn't it? It's over 40%?
Right.
It's moving upwards in 2013.
Okay. Do you know that? Or I just think that...
They have not finalized things, but my expectation is that it will move up.
Okay. So
Right, so the tax rate's going up, and that $5 million exemption is set to go down to $1 million.
So the tax rate is going up. I mean, so you're actually, the government is getting tax on money that's already been earned and taxes paid for. I mean, if someone has $5 million and they die, they've already paid tax on the $5 million.
Maybe.
Well, let's assume they do and say it's in a Merrill Lynch account or something. Then there's another tax on that money.
On the transfer of that money.
Right, to the heirs. Right? Does that sound fair?
Well, in many cases, it's not just the tax. It's just not the money in the Merrill Lynch account. It's the money in the IRA.
Right.
Other pieces of property, and monies that are in IRAs, the tax has never been paid.
They haven't been paid.
Right.
And
So it's considering all the assets in an estate.
well, we're sort of talking about tax planning here, but I'm talking about want to get back to the people who have not filed. It's just that once you don't file a return for 2010, you say, geez, I don't want to file a return for 10. Then you get into 11, then you get into 12. And it has a way of snowballing that you don't want to file tax at all. They come to your office and say, hey, I haven't filed a tax in 5 years. Can you help me?
Right, and most times we can. And it does kind of spiral out of control because a lot of times that first year they do prepare the return and maybe didn't anticipate because they were self-employed that you have this liability. They can't pay it.
Right.
So they essentially
don't
panic and say, well, I'm not going to file it because I can't pay it. And then the next year it's the same thing.
Well, you see that too in your practice?
Absolutely, yes.
I mean, how can you, isn't it sort of embarrassing to go to the government and say, my client hasn't paid tax in 5 years, hasn't filed a tax return? I mean, is there some kind of a criminal violation there when you don't file a return?
Yeah, there's a failure to file penalty that's assessed immediately.
It's a penalty. But people who report income improperly are different than people who don't file tax returns. Is that right?
That's great. It's another form of tax evasion, and I think that's maybe where you were going with that. There's, of course, penalties for late filing. There's fraudulent failure to file. There's also the tax evasion provision.
Is the best advice to tell people, file the return? I mean, it may be incorrect, but file the return, as opposed to not filing a return.
Well, it's important to file the return to cut off certain penalties that would, I guess, kick in if you did not file, because there's your failure to timely pay, which is one penalty, your late filing penalty. Both those will max out at 25% of the liability.
Really?
Yeah. So, but you can cut off at least the late filing penalty by timely filing, and then we can work it out on the collection side.
When you hear these cases of movie stars and people in the music business who owe $6 million, how does that happen, and what can you do with that?
Well, I think the most important thing is if you find yourself in a difficult tax situation, is to seek out proper counsel seek out a tax attorney or a CPA that has experience in this area.
And both of you agree that no matter what, you have to just go in there and say, hey, I don't have clean hands, I haven't filed, or I took too many deductions, I didn't report income, and that's the best way to do it, right? I
agree. I think that is the best way to do it because a lot of times it's fear of the unknown.
So there is mercy in internal revenue. Absolutely. Because most people perceive it as a stone wall.
Major funding for due process is provided by Meade Lexus of Southfield and Meade Lexus of Lakeside, offering a large selection of new and pre-owned certified premium vehicles.
Someday, your life will flash before your eyes. Make it worth watching. Introducing the 2013 Lexus LS, an entirely new pursuit.
And by WWJ News Radio 950, keeping you up to date with the latest news, traffic, weather, sports, and business information 24 hours a day, 7 days a week. Live, local, and committed to Michigan's future. News Radio 950, WWJ.